Welcome in, everybody. This is episode 3 in our mortgage series, and I am here with Tim Holley, Long River Realty broker owner. I am Jared Rail, realtor and appraiser with JR Appraisal Services, and Heather Petrillo with New American Fundy. Sorry about that. How you doing today?
Good. How are you?
Good.
I'm, I'm,
Um,
I'm surprised. I'm surprised you missed the name. We just talked about
I
this.
know.
I don't know. You can't take me anywhere.
He's just trying to make me feel younger because I'm the oldest one of the crowd, and he's the one with the memory issues. So that's good.
There you go. Way to be a team player.
I apologize, Heather.
You're good.
So we've been talking. We went through on our last episode through basically the whole mortgage process in a nutshell, from start to finish, from application to close. And we wanted to expand a little bit. One of the things that we want to talk about was the credit reports
Yeah.
and the tri-merge credit report. Can you explain a little bit more about that?
Yeah, absolutely. So the tri-merge credit report is the most complete full credit report that we as lenders can order. And what it is we get reporting from Experian, Equifax, and TransUnion. Okay, so we get complete information. When we pull this, we get any mortgage history information, we get any derogatory credit information, if we've had any late payments, if we are currently past due on any accounts, if we've had bankruptcies, those will report on the tri-merge. And also, if we have any liens or judgments against us, those oftentimes will populate on that tri-merge credit report. So it's very complete. Okay, compared to the soft credit pull that only pulls one credit agency. So outside of making sure that we have no derogatory credit, or if we do, what does it look like, right? Make sure that our any taxes or any liens or judgments or anything like that are addressed. Oftentimes, the tri-merge credit report will also tell us if a client is obligated to pay child support. Not always alimony, but child support. Which is very helpful because it's just right there. If your credit report says that you pay child support, I don't need all of your child support documentation, right? So it's in there. More than that, not all creditors report to all three credit bureaus. Okay, if I have a credit card with ABC Company, they may only report to TransUnion for their credit reporting, which means if I did a soft credit pull and I'm only pulling Experian, I'm not going to see this trade line from ABC Company, right? So that tri-merge credit report really gives us a good idea of what we're looking at. With that tri-merge, because we're getting reporting from all three bureaus, we're going to see three different credit scores, right? We're not going to see 620, 620, 620. We might see 620, 605, and a 697, right? Depending on which credit agency is reporting where and your history with that trade line. Does that make sense?
Yeah,
Yes.
I got a question on that actually.
Yeah.
So because everybody out there, and its credit score is not a big secret anymore. Everybody has an idea of what their credit is, and you may or may not know the answer to this, but when they're using a credit score site and they're monitoring their credit, and they call you and they tell you I've got a 620 credit. Is that generally coming from one agency? Is it coming from a compilation of all the agencies, or does it depend on which source they're getting it from, which agency they're pulling from?
It's actually a little bit of everything, right? So it depends on which credit agencies are reporting to that credit reporting site, right, or that credit reporting app, um, and how much information that app is pulling. How far back are they going to get this information? So it's very common for us as lenders to see a discrepancy from some of the credit reporting apps, or even some of the credit scores that your credit cards will tell you that you have, compared to what we're pulling, because of the depth of information that we pull when we run a mortgage credit report. So some of the credit reporting applications won't always report derogatory trade lines. If we've had collections or if we have past due accounts, they're not always reporting that. So of course they're going to report a much higher credit score than we would on the lending level.
So you guys just throw a dart at the board to see which one you want to use?
No, we stopped doing that a few years back. Uh,
Okay.
so
I
what
thought
we
I
do?
saw a dartboard in your background. That's not what that's for.
No, I took it down.
All right.
So really what we do as in lending is you have the three credit scores. You have a high, a low, and a middle. We take the middle credit score. Some people have said, I know you take an average. We don't take an average. We take the middle credit score. If I have two borrowers, each one has a high, low, and a middle, we take the lowest middle credit score between the two buyers. If I have four borrowers, right? We're looking at all three middle scores. Whichever one is the lowest is what your loan program is based on. It's not always, but that's a factor, right? Make sure that you're qualifying. What your credit score is based on, and really kind of helps paint the picture of where we're going.
And could that mess with the interest rate?
Absolutely, it can. So generally speaking, the lower the credit score, the more risk, which often results in a higher interest rate.
So I might have to kick one of the kids out of the house then.
You might need to, or you can add them to your credit card as an authorized user and just bump that credit score right up.
Yeah.
Yeah.
So when you have a buyer, a potential buyer, and you're qualifying them, and you're looking at all options net front based on down payment, and but you could have where they could qualify for FHA or conventional, and then you're going to crunch all the numbers, right, to determine what the best program is for that particular buyer in terms of after you add in mortgage insurance and all those things.
Absolutely. So when I have a client who can qualify for, several different loan programs, that's when we really dig in. Right now, we've done the pre-qualification. We know where you are. Now let's talk about the nuts and bolts of it. Right, where do you want your monthly payment to be? Is a question I ask all the time. Okay, based on this down payment, where's our monthly payment? What's our comfort zone? So then from there, we're going to look at the conventional loan, versus the FHA loan or VA, whatever we're looking at. And then from there, we'll go back and I'll say, okay, with the conventional, you're at this payment. With FHA, you're at this payment. And then the second question that I'm asked is, how much is it to close? So now we've thrown in a monthly payment, but now we're going to, double down on that with funds to close. So it's definitely a conversation.
And also, I guess you got to take a look at if there's an HOA.
Mm-hmm.
That plays in.
Yeah, HOAs definitely play a factor. Even if it's a voluntary HOA, oftentimes we're obligated to include that HOA fee because it's voluntary. You could do it, you could not do it. If you telling me you're not going to do it, that's fine. I can't assume that you're always not going to do it. So we have a couple of voluntary HOAs here, and fortunately, the HOA dues are very small, but they're out there. So we'll definitely look at that. Sometimes, in a lot of cases, actually, if I have a client who's trying to decide between FHA and conventional, depending on how much money we have down, my clients will sometimes choose the conventional option because even though we have mortgage insurance, conventional allows you to pay all of the mortgage insurance up front so that you can avoid it monthly in your payment. And usually you can do that at a reasonable price overall.
Yeah.
So for some clients, putting maybe 10% down or 15% down and paying all the mortgage insurance up front is cheaper than putting 20% down in the transaction.
Yeah, I remember a time when it seemed like if you could do a conventional loan, you did. You didn't go FHA unless you had to. And I think that's changed. I've seen a lot of people that when you really crunch the numbers and there's a lower rate for FHA loan, even with the mortgage insurance, the monthly payment still ends up being lower. And I know it's case by case, and that's kind of what I was getting at when I was asking that question. You got to go through the process and crunch the numbers, both scenarios, and weigh all the variables that go into it.
Mm-hmm.
Right.
Yeah. Yeah. And it's very time consuming, but for me, it's important that my clients see those differences because they're the ones that have to make that mortgage payment, not me, but it's a part of this whole process. It's a part of that customer service. And to me, I mean, this is a relationship based business, right? I want to do your loan. I want to do your children's loan. I want to do your friends' loans. So they need to really feel good about the information that I'm giving them. Because I'm giving you information to make an informed decision with facts, not with your emotions.
Are rate buy downs an option on any of the loan programs, or is that strictly to specific loan programs, or is that an option on just about any loan program?
Yeah, rate buy downs are an option on, all of your loan programs. In some cases, the DPAs won't allow it, but generally speaking, yeah, you can always entertain a rate buy down. And that's another conversation with my clients. Where is the interest rate? Where is the payment? And I sort of back it up with, again, where do you want your payment to be? Because if you want your payment to be 1,500, but your interest rate is 6.99% at no cost, right? That's a win. But if you have the blinders on about interest rate and you really wanted 6.5, right? And you're paying money for this and your payment's 1,400, right? Is that really a win? Right. So it's really, where do you want to be and what's the most efficient way to get there, and oftentimes with the least out of pocket expense. And what's the difference between the two rates? Is it a $30 difference in the payment? So a lot goes into those conversations. It's not just, here's your payment. Do you want it?
And especially with, they always say, and I say this all the time, date the rate, marry the home,
Yeah.
because 2 years from now, if everything drops down lower, you guys are sitting back in front of each other again going, what? We can refi this. And can they refi from one kind of loan into another kind of loan on a refi?
Mm-hmm. In most cases, yes, you can. And the average person keeps their loan for about 3 years. So I tell my clients, even last year when rates were crazy high, and even now, some clients feel like interest rates are high, and I mean, they're high, but to me, it's not a deterrent, right? Because if the payment makes sense, if the payment is you're able to make this payment and still maintain finances, you're not strapped for anything, then why would you let a rate deter you from buying a home? Because your home is going to build equity, right?
Right.
The average homeowner keeps their home for 7 years. So if I'm going to keep this house for 7 years and my interest rate is 6.99 at $1,500 a month and I can afford it, I'm comfortable with that payment, why would you wait for anything else to change?
Well, and our rates are what they are today, but historically, it's not really that bad
No.
No.
from the standpoint of borrowing money.
Mhm.
6.5 or 7% historically isn't horrible, but we're coming out of this period where 2 and 3 and 4%, and everybody wants it to go back to that. And
It's not
I'm not seeing it in the next. I think it could be
ever.
in the next 20 years. We might not see less than 5. I don't know. I mean, we don't have a crystal ball, but that's not the norm. And if you're going to wait for that, you may never. You're going to be waiting forever the rest of your
Yeah.
life.
And if
Potentially, you
if
never
you're gonna
know.
wait and wait for that and keep looking back, all you're gonna get is a sore neck. You're
Yes.
not gonna make progress.
Yes.
Look ahead, move forward.
Right. I mean, the area that you live in, of course, matters, right? Like anything, it's all relative. But generally speaking, real estate is always a good investment, right? Especially if you plan to keep your property for, 5, 6, 7, 8 years, right? At some point you have to join the race with the rest of us. Otherwise, we're just passing you by.
Right.
You can rent, $2,000 a month in rent, you're giving away a lot of money every year and gaining nothing for it.
Yeah, when you own a home and you sell it and move, you generally make a load of cash.
Mm-hmm.
When you rent a home and give notice to move, you generally lose money because you put in those first and last and securities, and a lot of that doesn't come back. So not very many put more money in their pocket when they leave a rental than what it costs them to get into the rental.
Yeah, I think a lot of people, myself included, from time to time, we get blinders on and we can only see right here what's in front of us. We don't have the ability to see long term, right? And if we are, renting a home, right, we're not getting a lot for it. But if we, take a chance and talk to a real estate agent and talk to a loan officer and see what your abilities are, what can we do? Then now we can project. We can say, okay, I can only afford $200,000 right now. I'm going to buy this $200,000 house. My payment's good. We're going to live in this for 3 or 4 or 5 years. And by that time, we're ready to have a family. We're going to take this equity that we built over these 3 or 4 and 5 years, and now we're going to upgrade and we're going to buy our dream home. So a lot of times I think we just see, oh, I can only afford 200,000. I'm just going to wait. But what are you waiting for?
Yeah.
Are you going to win the lottery, or are you going to get an inheritance? Like those are, I don't know.
Or prices are going to go up, and that $200,000 home is now a $400,000 home. So when you try to upgrade, it's going to cost you more money
Mhm.
than if you would have just did it today.
Well, here's the other thing. As interest rates decline, the market becomes more aggressive, right? So a situation where today, if you want to buy a house at 200,000, you may not have a lot of competition, right? You might be one of 2 offers, maybe. If interest rates were a whole point less, you're one of about what, guys, 7, 8 offers
Yep.
on a house that's priced right,
Yep.
including cash, I'm sure.
Yeah. It
So
all changes, and I was talking to a gentleman the other day that had spoken to another agent, and that agent was telling him, well, if you had bought about 4 years ago, you would have got a really good deal. Well, and he was telling me this, and I said, well, you just told me that you're selling your house in another location today. So if you had sold that house 4 years ago and bought a house 4 years ago, you'd be selling and buying in the same market.
mhm.
So selling and buying in the same market today is no different than selling and buying in that market 4 years ago.
Right,
It's you're moving both houses in the same market, so it's really a moot point. It doesn't even matter.
right.
And the thing is that you buy today, and in 5 years from now, you're going to make money off of that. So it's like, just keep on buying, people. Keep on punching. Just
Yeah,
keep on going, and you'll be fine.
yeah,
I've always said the biggest thing is you can't be forced to sell. If the market's down and all of a sudden you need to move, that's when you can really get stuck. If you're able to keep it and rent it, or even if you have to move to another area,
yeah,
rent it out. Don't sell it while it's down.
right,
Eventually it's always worth more.
right.
Eventually, if you look at the trend line going back however far you want to go back, it's always gone up. Eventually, yes, there's dips in there, but I mean, we're way higher than we were at the last crash. So, doom and gloom. That's not really the way to look at it. You have to be able to. I've kicked myself. There have been a couple of opportunities that I wanted to buy stuff, and I don't want to pay that. That's too much, and I'm kicking myself a few years later, and
As
I
you're
had the
appraising
same
it for sale.
house twice. Same house twice. I thought I should buy it, and then I go, no, that's too much. I can't afford that, or that's too much money, or they want too much money. And a year after that, I'm going, man, I should have bought that house. I really
Yeah.
missed it, and you
Yep.
can't. You don't want to be stuck in that. You got to be willing to pull the trigger. There's no reward if you don't take the risk. It's risk reward.
Hmm. Yeah, I
Um,
agree. I agree. I've said this once, I'll say it again, and you guys will hear me say it forever. This is a relationship based business. So find yourself, the real estate agent that you can rely on, the lender that you can rely on, and ask them those questions. I'm sure several of your clients call both of you and ask you, how's the market doing? Would it be a good time to sell my house? Should I wait? Should I buy? They're really relying on you as the expert, because this is what we do day in and day out. We don't do anything else. Well, 2 of us don't.
we talked on a previous episode about the like statistics, and you see stuff on the news, and they're just selling the negative, and the statistics, like Tim pointed out, you can make the statistics show
Yep.
whatever you want them to show. You change the date, the length of time you're looking at, and things like that, and it'll show whatever you want the numbers to show. But the fact of the matter is, real estate goes up over time. It will go up eventually. Even if you have a down period in there while you own the house, it'll go up. um, what what about things that you should or should not do during the course of a transaction?
There's
Well, I'm buying a house, you've got me pre-qualified. What should I not do? Let's start there. That's probably more important than what I should do.
the should not do list is a longer list than the should do list. So you should not buy a new car. You should
Oh, man.
not co-sign for anybody for any debts. You should not change jobs. You should not quit your job. You should not file for bankruptcy. You should, depending on your loan program, you should not get married. Depending on your
Not
loan.
just quitting a job, not changing a job, right?
Yeah,
Oh, I'm tired of this. I'm going to do this, and it's more money. Well, that could blow up your qualification because now you don't have the work history.
And
right.
just like,
Change.
I've seen it just baffles me.
Yeah.
Oh, we're going to close escrow next week. I better go out and buy furniture for my new house. Look at this. I got a credit card that has a lot of money on it. Let's spend it.
Or my favorite, the home improvement store was offering 20% off for Memorial Weekend and then another 10% off if I applied and got approved for their credit card.
Right.
We're not going to do those. Don't do that.
Don't do anything while you're buying a house. Don't
deposit
buy
cash.
anything. Don't open new credit. Don't use new credit. Um, what about funds? My funds are getting a little low because I'm spending money during this process. I'm going to go to my safe and pull out that cash that I set aside and throw it in my account because my account's getting a little low. What's up with that?
Generally speaking, that is a no-go. That is not a good idea. The government says cash doesn't exist. So if it doesn't exist, then we cannot use it for your transaction. Now, there are some cases where small cash deposits are allowed, but talk to your loan officer about that so that you understand what can be deposited and how it affects you. Generally speaking, no cash deposits. Okay. If our funds are getting low, and we've spent more money than we should have from our verified assets that your underwriter said, yep, you've got X amount of dollars in the bank. That's plenty of money. That's what you need. And then you went and spent some of it. Well, now we have to see if we can talk to mom or dad about getting a gift to supplement what you're short. Or perhaps in some cases, we have to switch your loan program to a down payment assistance program and utilize, one of the state bonds to supplement that difference.
And then that could change your close date. And if you're having to change the loan, now you have to go back to the seller and make sure the seller's okay with you changing your loan style.
And you have to go back to the underwriter and say, I've changed my loan. Do I still qualify?
Right.
So do not do
that. You're starting the whole process. You're opening up I like to call it the can of worms. You don't want to open cans of worms when you're in the process of the transaction. You want to get through the transaction, then you can go buy some furniture if you need to, or then if you were waiting, wait till after the transaction. If it's time for a new car, great, but don't do it until not even the day of close. Wait till after. Let's wait till later.
Having a professional in the industry that you can call and text and ask these questions before you do these things is so important, instead of having to email some generic email inbox and hope that somebody will reply to you within 24 hours.
Yep.
We talked about cash, but I mean, you need to be able to source all funds coming into the account. If there's a large deposit from somewhere, you can't just take a check from mom and dad and deposit it into your account, because your lender will have to source that and source any large deposits that are any anomalies in your bank statements, right?
That is true. You're absolutely right. And it's just as black and white as it sounds. If I have a large deposit and with no explanation, I got to find out where that money came from in order for it to be eligible funds for your transaction. So if mom and dad gave you a check because you graduated college and you deposited it into your account, and now you need to use it for your funds to close, I not only need the bank statement from mom and dad showing that check has cleared their account, I need your statement, and in some cases a copy of the check.
In some cases, do you need a letter from mom and dad supporting that?
Yeah. So what accompanies that bank statement is something that we call a gift letter, and mom and dad have to acknowledge that they had given you those funds.
So they can't take the $500 cash out of their safe to put it in your account. That doesn't work that way.
No.
Nope.
We do not like that.
How about cash to close and closing costs? Those are two different things. Can you give me, is there like a rough percentage of a transaction that you usually see for closing costs?
Mm-hmm.
And then how does that break out with cash to close?
Yeah. So closing costs on average are going to be anywhere from 2 to 4% of your purchase price. Okay. And I give you that broad range because purchase price matters, right? Where the property is matters. Your closing, so you have your down payment, which is what our buy-in is as a buyer, your down payment, 3.5%, 5%, 20%, whatever that is. Okay. In addition to that, you have closing costs. Okay. Your closing costs, easily defined as the cost of doing business. Everybody that's involved in the transaction has a fee for their services, from the escrow company, the title company, the appraisers, to us as your lender. Believe it or not, we don't work for free. So everybody involved has a fee for their services. Okay. Those closing costs are going to vary based on the property you're buying. What are the property taxes for that property? Where has the homeowner's insurance quote come in for that property? Where is the interest rate? Because we're going to have some prepaid interest that we have to pay. Did we choose to pay any points for that interest rate? Right. So on average, you can expect between about 2 and 4% of the purchase price to be closing costs. So we have our down payment, we have our closing costs. The two of those combined is what we refer to as your total funds to close. Okay. In some cases, you can ask the seller to pay for your closing costs, but the seller is not obligated to say yes. The seller can say, I'm paying for your real estate agent commission. Kick rocks, kid. You got to pay for your own closing costs.
Yeah, and
Right?
sometimes on insurance on a loan, don't they have to pay for the full year up front on the insurance?
Mm-hmm. Yep. So with the insurance, we pay the whole year in full. And then if you have an impound account where your property taxes and your homeowner's insurance are included in your payment, you pay an additional 3 months of that premium that will go into your servicing account. And those we refer to as prepaids. So it's very
most of your traditional loans are going to generally require some sort of an impound count, right?
most often, yes, depending
Meaning,
on.
if they're loaning money, they want to make sure that you're setting aside money for taxes and insurance, so they require that as part of the process, and usually they handle the servicing of that, right?
That's right. So companies that service loans, like my company, for instance, we service our loans. So you are going to make your payment to New American Funding until you refinance or pay it off or sell it or whatever, what have you. So our servicing department does a very good job of managing those servicing accounts with property taxes, homeowners insurance, all that.
And one of the nice things about your company, and we talk about this and I praise it all the time, is you're an actual bank
Mm-hmm.
for a lending bank.
Mm-hmm.
So
Yep.
that's a big difference there. You guys do all your stuff in house.
Yep. We have the ability to broker. We have several broker partners if needed. However, the majority of my stuff fits right under our umbrella, and it works because our underwriters are familiar with, my area. They're familiar with the type of clients that I see most often and property types, because you both know as well as I do, you could have $1 million riverfront home and across the street might be a double wide manufactured home. And, to understand the appraisal and what goes into that, or, even just that area with such a broad, mixed use of properties, our underwriters really get to understand that. And so it just becomes, easier and easier and easier because they just see it one after the other after the other.
Something
In
that's
appraisal, we call that geographic competency, and we're as when you're doing an appraisal, it's part of the ethics that you are saying that you're geographically competent to cover an area when you accept the assignment, or you have to let them know that you're not and what steps you're going to take to become competent. And that's the same thing. You need to know what you're dealing with. You need to know what's going on in the area. You don't want to just come in from somewhere else and not have a clue what's going on.
Nope.
And one of the things that's very important in a contract that people, sometimes sellers generally, there's a 3-day clause towards the end of the contract, Heather. And I've seen sellers blow a gasket when
When we're there.
we're there and it's exercised. Tell us
Yeah.
about that.
So at the end of your transaction, we're required to issue something called a closing disclosure. And that closing disclosure is a summary of your loan terms, right? Your loan amount, your loan type, interest rate, principal, interest, payments, impounds, all that, your APR, all of the fees involved in your transaction. We call that a closing disclosure. When a borrower signs a closing disclosure, there is a 3-day waiting period. It's called the TRID period. Okay. The 3-day waiting period starts the day that that closing disclosure is signed, and 3 days must pass before you can fund your loan. Okay. Actually, before you can sign your loan documents and fund your loan. So we have to have that 3-day wait period expire. It's very common. So, you know, as in lending, you want to, you have to lock in your interest rate to get to this closing disclosure part. Okay. So you don't want to wait too long to lock your interest rate, because if you wait too long, now you have to go through TRID, which means you could be in, peril of having to extend escrow. So, that communication again with your lender is very important, so that you know when the best time to lock in your rate is, so that we can get your closing disclosure issued, so that we're not missing your close of escrow date.
Is that 3 calendar days or 3 business days?
It is not, it is calendar days excluding Sunday. Right. So if I have a closing disclosure that's issued on Thursday and I sign it on Thursday, Thursday is a rescission day, Friday is a rescission day, Saturday is a rescission day, which means I can sign and fund my loan on that Monday. But if my closing date was last Friday, it doesn't help.
Yep.
All right. Well, that's all really good information. Tim, do you have anything else for this?
No, I think
episode?
I'll be having some lending dreams tonight. So
There you go. I have them every night.
Yeah. So Heather, tell us again, and we appreciate everything you've done, the education, the many, many, many deals that we've done with you and will continue to do with you.
Yeah.
How can people get a hold of you so they can have that same pleasurable experience?
Yep. The best way to contact me is my cell phone. It's 928-444-5900, or stop by the office. We're here in Bullhead City, Monday through Friday, 8 to 5.
All right. Jared, anything else for you?
No, I really appreciate you joining us, Heather. Thank you. Great information.
It's been a pleasure, guys. Thank you.
Thank you, everybody. Have a great day.